Shorting options is an often confusing term for beginner options traders because shorting options refers to selling something that you do not own. But in this video, I'm going to clean up how shorting options works through lots of examples and a live demonstration of me shorting and buying back an option so you can see exactly how it works in practice. In the physical world, you can't sell something that you don't have in your possession. If I don't have a car, I can't sell the car. But in the digital world of stocks and options, traders can choose to bet against the price increase of something by shorting them. Therefore, a normal stock investor is going to buy low and sell high, and a trader who is taking a short position is selling high and ideally buying low. If I short a stock or option, I make money as the asset price decreases. Here's an example of a call option in Apple. So here we have a 180 strike call option in Apple with an expiration of December 2022. We can see that the option's price went from $1 to over $9 when Apple's price went from $130 to $175. Let's say a trader wanted to bet against the price increase of Apple, and they did so by shorting a call option. Let's say they shorted the call option here when it was $6. Therefore, they would have collected $600 into their account. But as we can see, the option price went up to over $9. And if the call option's price goes to $9, therefore it has a value of $900 per contract, they would have an unrealized loss of $300 since the call contract increased in value from when they shorted it. However, as time passed, Apple's stock price went back down, and at expiration for this call option, the stock price was well below the strike price of $180, and we can see that this call option ultimately expired worthless. Therefore, the trader who shorted it for $6 saw its price go to zero, and therefore they would have ended up making $600 on that short call position. If we look at this risk graph, we are looking at how much we can make or lose when shorting a theoretical 260 strike call option. And this call option has an entry price of $2.15 and 60 days to expiration. The stock price at the time of entry is $250. And as we can see here, if I short this call option and the stock price begins to increase, then I will start to lose money on this short call position. But if the stock price stays below 260 and ideally falls lower, I start to make money on this position. At the time of expiration, we can see that as long as the stock price is below 260, which is the call strike price, this position will make $215 at the time of expiration. However, as the stock price goes up, if it goes to 265 or 270, then I will start to see some serious losses on this position. The short call strategy has theoretically unlimited loss potential to the upside, and that means if I were to extend this stock price chart all the way to the right to infinity, the losses on this position would continue to grow. And so shorting call options is a super high risk strategy that I generally do not recommend. In this example, we're looking at an Apple short call position, and the strike price of this option is $160. At the beginning of the period, Apple's stock price was around $154, and this option had 46 days until expiration. The entry call price is $3.15. As we can see, Apple's stock price did increase and ended above the called strike price of $160, and we can see that the call options price also increased to a high price of about $8, but at the time of expiration, the call option was worth around $5.02. This gives this short call position an ending loss of $187 per contract. That's because if I short a call option for a total premium of $315 and the options price goes up to $502 at expiration, if I collect $315 and then pay back $502 to close the option position at expiration, my final loss is $187. In this next example, we're looking at a super big loss when shorting a call option, and this is in NVDA. In this example, we're looking at a 320 strike call option with 46 days to expiration, and the stock price was at $289.10 at the time of entry. The entry call price was $8.05, and so if I shorted this call option, I would have collected $805 into my account. Unfortunately, NVIDIA's share price went way higher, and at the time of expiration, the stock price was at $426.92. And this resulted in a final call option price of $106.92, which actually represents a value of $10,692. And therefore, the short call trade in this example experienced a final loss of $9,887 per call option sold, which highlights the high-risk nature of shorting naked call options. It's important to note that when shorting options, you can get assigned on the option, which effectively means that your short option position is converted into a stock position at the option's strike price. This happens because option buyers can exercise their options, which means that they are choosing to buy or sell shares at their option's strike price. In the case of this 320 NVDA call option, if I got assigned on this short call, I would sell 100 shares of NVIDIA at $320 per share. Note that this would not increase the loss potential or risk of the trade, but it would change the structure of the trade. And if any option that is in the money is held through expiration, that option will automatically get exercised, which means if you are short that option, you will automatically be assigned. And for that reason, I always recommend closing option positions before expiration if they are in the money. Now let's switch gears and talk about shorting put options. Shorting put options is an option strategy where you sell put options you do not own. Because put option prices fall as the stock price increases, this means that shorting a put option is a bullish options trading strategy. When shorting put options, you make money over time if the stock price goes up or at least remains above the strike price of the put through the expiration date. But just like shorting call options, shorting put options has significant loss potential to the downside, since if a stock's price collapses after you short a put option, the put option's price is going to increase dramatically and you are going to have big losses on that position. Here we're looking at a risk graph of shorting a put option with a strike price of $240 and the stock price at entry is $250. The call option has 60 days to expiration and the entry put price is $2.50. And so if I short this put option for $2.50, I collect $250 into my account, and we can see that as long as the stock price is above $240 at the time of expiration, this trade will make $250. However, if the stock price decreases significantly over the trade period, we can see that I have big loss potential to the downside, and the losses will continue to grow as the stock price falls further and further below the strike price of the put. The worst case scenario is to see the stock price go to zero, at which point the put option will be worth its strike price, which in this example is $240. So if I short this put option for $2.50, the worst case scenario is that the stock price goes to zero, in which case this put option will be worth $240. And that would obviously be a gigantic loss. In this example, we're looking at shorting a put option with a strike price of $275 in NVIDIA. The stock price at entry was around $290, and this put option had 46 days until expiration. The entry put price was around $13, which means if I shorted this put option, I would have collected $1,300 into my account. As we can see, the stock price initially did fall lower and briefly touched the strike price of $275, and we can see that this put option's price actually increased to $17.50, which would represent an unrealized loss at the time of around $450. However, we can see that NVIDIA's price did soar higher, and at the time of expiration, NVIDIA's stock price was way above the put strike price of $275, and therefore this put option expired worthless. And in this last example, we're looking at a huge loss when shorting put options, which is in QQQ, and this was when the stock market crashed in 2020. So we have an entry stock price of $222.38. The put strike price was $215, 57 days to expiration. The entry put price was $4.23. As we can see, QQQ fell off a cliff and traded down to $170. And as we can see, the puts price reached a value of $45 at the lowest point. And so since the put option was sold for $4.23 and it reached a high price of $45, the unrealized loss at this point would have been around $4,100 per put option shorted. At expiration, the put was worth its intrinsic value of $24.60, and that would result in a final P&L of minus $2,037 per put option shorted. I generally do not recommend shorting naked options, which means to short a call option or short a put option without protection. The only exception would be if you are shorting cash secured puts, which essentially means you're shorting put options with the expectation that you might get assigned on that put option and purchase 100 shares of stock at the put strike price, in which case you're keeping enough cash available in your account to fulfill that share purchase of 100 shares at the put's strike price. Other than that, if you want to short options, I generally recommend that it is done with a spread. So that means selling a call spread or selling a put spread. I just did a video on put credit spreads, and I have lots of videos on my channel about other types of call spreads and put spreads and iron condors and all of those things, which include short options. But other than that, I generally do not recommend shorting naked options under any circumstances due to the high risk, low reward nature of the strategy. If you want this presentation in PDF format so you can study the examples used in this video, the link to download that PDF is down below, and you will also get a bunch of other bonus PDFs that I am including with my new options trading videos going forward. I want to walk through an example of shorting a put option so you can see what it actually looks like to short an option using real trading software, and how you can close that position out and how the final P&L is determined. For this example, I'm going to be looking at XLU simply because it's a low-priced, low-volatility ETF, and that means the option prices will be cheap and the risk will be minimal for this example. So here I'm opening up the December options expiring in 2023, and they have 35 days to go. And for this, I'm going to short the 60 strike put option. So here I've clicked on the bid price of that 60 strike put option, and we can see that with the price of $1.06, the max profit potential is $106. The max loss potential says it is around $5,900, which would only be the case if the stock price went to zero. But since this is the utilities ETF, the likelihood of going to zero is basically zero. And so this is a relatively safe way to short put options. Since you have a lot of risk involved when shorting a naked option, like shorting this 60 strike put with no other options used as protection, you do need to put up a high margin requirement, which is simply the amount of money that you need to tie up to account for potential losses when entering the position. So here we can see that the margin requirement or buying power effect says $1,182. And this just means that to short this put option for $1.06, I need to put up or tie up $1,182 to account for potential losses on this position. So I did get filled on this trade for an entry price of $1.06, and this means my maximum profit potential, if this put option were to expire worthless, would be $106. But for the purpose of this example, I'm just going to wait and see what the put option price does as XLU's price changes, and then I'm going to close out the put option for just a couple pennies just to demonstrate what it looks like to enter and exit a short option position. Here we can see the put option's price has actually decreased to $1.05, and since I shorted it for $1.06, it says my open P&L, or P&L since opening the trade, is a positive $1. And that's because XLU's price has increased very slightly since entering the trade. So to close this trade, I just have to right-click on the option and hit close position, and this will queue up an order to buy back this short put option. And I just sent an order to buy back the put option for $1.04, and we're going to see if that gets filled. But as we can see, the order is not yet getting filled. It is a working order, which means I'm trying to buy it back for $1.04. The market has not yet gone to that price, and so my order is not yet filled. But if the put options price does drop to 104, then I will get filled on this trade. So I just need XLU to increase slightly, or I need some more time to pass for the options price to decrease a little bit, and then I will get filled on this trade and successfully close it out. So it's not getting filled, and I just want to close it out, so I'm going to right click, hit replace order, and then I'm going to increase the purchase price to $1.05, which brings my profit to $1, and that went through. So in this example, I successfully shorted a put option for $1.06, and I bought it back for $1.05, therefore securing a $1 profit, a huge $1 profit on this trade example. This is not how I would actually go about trading short options. I just wanted to demonstrate a very simple trade entry and trade exit using real trading software so that you could see how this strategy works in practice. The brokerage platform used in this example is tastytrade, and tastytrade is generally running special funding promotions, which you can check out in the link down below. If you love the work that I do here on this channel, using the link in the description below is a phenomenal way to say thank you. I hope you enjoyed this video and it cleared up what shorting options is and how it works. My name is Chris from Project Finance, and I will see you all in the next video.